You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks.
Peter Lynch, How to Invest During High Inflation. In March, Americans had to dig further into their wallets as yet another important inflation indicator revealed that prices had risen to a new 40-year high. According to the Commerce Department, the Personal Consumption Expenditures Price Index climbed by 6.6% for the year ending in March. It was the highest rate since January 1982, exceeding the previous month's number. Due to the conflict in Ukraine, energy prices rose in the first quarter, jumping 33.9% for the year ending in March. During the same period, food costs increased by 9.2%. Peter Lynch has shared his strategies on how to invest during the time of high inflation. Make sure to stay tuned until the end. People are concerned about inflation as we're uploading this video. Inflation is the process by which everything becomes more expensive. Businesses despise inflation because it reduces their ability to profit. For the same reason, investors dislike it. It has been a long time since the 1970s, but it was the last time inflation was a major concern. The 1970s are widely regarded as one of the worst decades for investors. In 1979, inflation reached an all-time high of 11%. It reached a climax in the early 1980s when the Federal Reserve Bank, led by Paul Volcker, reduced the money supply, causing the 10-year Treasury rate to rise to nearly 15%. That inflationary flame was quenched as a result of this, until now that is. Without going into why inflation is occurring, it looks that we are now facing a future comparable to that of 1970s America. Simply Google inflation and you'll get a slew of articles explaining why we're in this predicament. Inflation was another one of those phenomena that Lynch saw as being beyond his control. Therefore, he didn't spend much time worrying about it. Individual firms piqued his interest, and macroeconomics was a distant second. Trying to forecast what would happen with interests or the stock market in general was meaningless to him. Lynch kept things straightforward. He was aware that the stock market could go up and down at any time. Trying to guess when something would happen was a waste of time. He only looked at the long term because the stock market rose over time. According to him, because the stock market is linked to the whole economy, one method people try to beat the market is by predicting inflation, recessions, booms and busts, and interest rate direction. True, interest rates and the stock market have a beautiful relationship, but who can predict interest rates with any degree of certainty? In the United States, there are 60,000 economists working full-time attempting to foresee recessions and interest rates. And if they could do it twice in a row, they'd all be billionaires by now. It's sometimes tough for investors to remember that they're investing in businesses, not stocks. The more you understand about the industry, the more likely you are to succeed as an investor. A stock market correction can result in a 50% or greater drop in the price of a stock. However, if you know that the firm is still robust and profitable, you won't be intimidated by the price drop at those times. Earnings are an important measure to consider when assessing a company's health. Earnings, according to Lynch, are what determine a stock's price. When earnings fall, the price falls with them. The price rises in tandem with the increase of earnings. He went on to say, we've had recessions and inflation over the previous decade, as well as ups and downs in oil prices, and these equities have always followed earnings. Take a look at the Dow chemical chart. When earnings rise, the stock rises with them. That's exactly what happened from 1971 to 1975, and then again from 1985 to 1988. Earnings and stock prices were unpredictable in the interim, from 1975 to 1985. Lynch's focus on individual businesses, their revenues, and having a long-term time horizon are important lessons for anyone who wants to be a successful investor. Despite the threat of inflation, there are opportunities for investors to profit. Although we are not Peter Lynch, we believe that in this type of economy, some enterprises are better than others. We understand that this is contrary to Lynch's recommendation to ignore the macroeconomic picture. However, Lynch claims that success with cyclical companies is contingent on recognizing what's going on in the overall economy. Furthermore, for investors all across the world, Peter Lynch is a rock star. One reason for this is his substantial writings, in which he explains how he invests in a straightforward manner. Money Today explains how his investing method might help you. One reason for this is his voluminous writings, in which he explains how he invests in a straightforward manner. Perhaps the most impressive statistic is that as a fund manager, Magellan generated an average annual return of 29%. During Lynch's 13 years as fund manager, from 1977 to 1990, the fund outperformed its benchmark, the S&P 500. Reading One Up on Wall Street will teach you what made Lynch a brilliant investor: a good fundamental philosophy, a set of unique instruments that worked, and an investment worldview that was founded in reality, says Aswath Damodaran, professor of finance at New York University's Stern School of Business. To illustrate, he claims that inflation and interest rates in the United States when Lynch was a fund manager were not the same as they are now in the whole economy. According to Lynch, a mature corporation in the United States grows at a pace of 2 to 3% each year, which is similar to inflation. Long-term inflation in India is around 5 to 7%, necessitating a change in the rate at which the slow-growing corporation should expand. Lynch is at his finest when he's giving advice on how to investigate a firm, as well as what to look for and what to ignore. He also discusses how to classify a firm based on its market value and life cycle. Most importantly, he recommends investors to stick to their areas of expertise, something that famed investor Warren Buffett likewise advocates. Lynch argues that a doctor will always know more about medicines than a civil engineer, and hence will be in a better position to appraise pharmaceutical companies. Similarly, a car salesperson will know more about his firm and competitors than others, and will be aware of rising and dropping sales before stock analysts. Lynch's investing technique included categorizing companies into 6 groups and outlining explicit expectations for each. This enables investors to pinpoint the most important areas to concentrate on. The first group is known as slow growers. These are significant enterprises that have been around for a long time and are predicted to expand at a little greater rate than the country's GDP. Slow growers' biggest distinguishing feature is that they give out regular and significant dividends. A dividend check is always nice, thus they must be included in the portfolio. The second group is known as stalwarts. These are also quite enormous, but they haven't lost all of their steam yet. Lynch recommends a clear approach in this case. Investors should buy for a 30 to 50% gain. These companies aren't meant to be kept indefinitely, but they should be included in a portfolio because they provide protection during a downturn and reasonable returns when the market is up. Fast growers is his favorite category. They can yield the biggest returns, according to Lynch, but are also at risk of extinction. These are young, tiny, and aggressive businesses with the potential to grow at a rate of 20 to 25% per year. He explains this category as follows. This has no bearing on the industry. Even in a slow-growing business, a fast-growing company can exist. Another risk of investing in such a company's shares is the rapid price drop that occurs when they stumble. The trick, according to Lynch, is to figure out when they'll start slowing down and what the best purchasing price is. Cyclics is the third category. Automobile, airline, tire, steel, and chemical firms are among the companies that experience a regular, if not predictable, rise and fall in sales and profits. Cyclicals thrive when the economy is recovering from a downturn. However, if an investor buys a cyclical stock at the wrong time, they could lose a lot of money. Even if it is believed that you should not time the market, timing is crucial in the case of cyclical enterprises. If you don't sell the hottest stocks smartly, your winnings will quickly turn into losses, he says, because when the price falls, it's not going to fall slowly, and it's not going to end at the level where you hopped on. Another recommendation from Lynch is to avoid companies that diversify into unrelated businesses. This is referred to as diversification by Lynch. According to him, such businesses should be re-evaluated by investors. It might be preferable to make a profit on them. He also adds that because stock markets can be irrational, one should only invest what they can afford to lose in equities. Lynch also advises investors to analyze the price to equity, or PE ratio, for the previous several years before purchasing a stock to obtain a sense of its regular level. If a company's PE is high, it's also important to look at its PE growth rate. Lynch is credited for using this figure to determine whether a company is worth investigating. To calculate the price-to-earnings ratio to growth, he divided the stock's PE by the growth rate. Investors can also look at the market index to see if it is a good moment to invest, according to Lynch. Following your investment, you must monitor it on a regular basis, at least once every 6 months. Stock ownership is akin to having children. Don't take on more than you're capable of. Lynch's track record demonstrates that investing in individual firms over the long run is a viable strategy for combating inflation. So that brings an end to today's video. Thanks for watching. If you enjoyed it, please like, share and subscribe to our channel for more such great content.